Welcome back to Unblocking the Chain, the podcast about digital assets and crypto. I'm your host in this episode, Drew Bradford. I'm joined today by Dr. Robert Waugh, the Chief Technical Officer at Catena Digital. And today we are going to talk all about stablecoins. In recent years, stablecoins, digital assets pegged to traditional currencies, have emerged as a pivotal component of the global financial landscape. Stablecoins are designed to combine the stability of fiat currencies with the efficiency of blockchain technology, and they have facilitated seamless cross-border transactions and enhanced the liquidity of the cryptocurrency markets. Stablecoin market has witnessed remarkable growth. There's $200 billion of stablecoins out there, predominantly US dollars as of earlier this year. And the daily turnover is about $60 billion a day. So welcome, Rob.
Thank you.
Glad you could join us today. How about you give us a quick update on you, how you got to be in this space, your journey in crypto.
My journey in crypto.
Start from the beginning.
Thank you. Good morning, Drew. Thank you for the invitation today. Also, glad you used my correct salutation. So nobody really uses doctor anymore. I certainly don't. And but I suppose that's the kind of beginning of the journey. So originally, not a crypto person, and not even originally a banker, which is what we were both before crypto, but originally a physicist working at one of the particle accelerators in Europe. And so I suppose that, because I'm now the chief technical officer of Catena Digital, which is kind of a return, right? Interestingly enough, because I started off in a very, very technical field, on a particle accelerator, a particle detector, analyzing massive amounts of data coming out of one of these things, and developing what we called at the time kind of grid computing, which is now called cloud computing, and distributed computers analyzing massive amounts of data. And so that was where I started, and then got to the end of that and realized that I wasn't, I was okay, but I wasn't as smart as some of my contemporaries, and realized I was not going to be Albert Einstein, but I could still be Warren Buffett.
Perfect.
So I left and went, and you must know this, right? Because you were on trading floors for half your life. So tons of physicists, PhD physicists, turned up to trading floors in the late 90s and early 90s.
Absolutely. The maths in derivatives attracted those people.
Yeah. And so I rolled up. First day, they put the stack of books. I can probably even remember what there was. Fibonacci, fixed income mathematics. That's pretty thick.
That's pretty thick.
Hull, obviously, options, and a bunch of others.
Did you get that dynamic hedging was the one?
Yeah. From Ito calculus, which is interestingly enough like rocket. The Ito calculus is used in guiding rockets, which is why it's called rockets. It's not rocket science.
Path-dependent options.
Path-dependent options. And so that was. So it was actually reasonably easy to transition from working in a international collaboration of like highly technical people, which is essentially what a physics research place is, into a trading floor. And certainly, I was about to say like more interesting characters on trading floors, as I'm sure you know, but there are interesting characters in physics as well, very much on the similar kind of spectrums. And so it was kind of a natural transition. So I did a bunch of stuff in the trading floor, switched from trading to a kind of sales role, because I think I didn't stare at people's shoes. That was the criteria. And then from that into being a kind of a proper banker, like coverage banker. And then I think it was when I was at ABN AMRO when we got rescued by RBS or bought out by RBS, and then everybody got rescued by the Chancellor. And Bitcoin reference there. Chancellor bails out banks.
Yep.
And then I was just I was on the trading floor when RBS got its margin calls when it got its rating. You remember this when they got the ratings downgrade to whatever it was?
I remember queues in London outside
the branches.
branches.
And Northern Rock had already happened. In particular.
Northern Rock.
And so we got the margin call because like RBS had been downgraded, and everybody came in the morning and they were like, right, check your derivatives positions, who's got collateral calls. And it turned out, I probably shouldn't give too much specifics. It's probably still captured by non-disclosure, but there was it was evident that there was just a massive capital call from a number of the positions that we had on the trading floor, and then we got bailed out on the Monday, and that I think that was a moment where I was started kind of questioning myself about the nature of money and liquidity, and like if banks create money, like why is this happening and stuff like that. And from that, I found the Zero Hedge website, and so. Yeah, and then on Zero Hedge, I found Bitcoin, and so that was like whatever 2000, late 2000 and noughts, early 2010s, and that was it. That was like that. Because when you find it, and you realize it's like suddenly watching a color TV when you were watching a black and white TV before.
Yes, it's a journey. Once you've studied it, you can't go back. So. Catena Digital, an Australian stablecoin issuer, Australian dollar stablecoin issuer. What are your role as Chief Technology Officer there? What are your day-to-day goals right now?
So, hopefully, a fully regulated Australian dollar stablecoin, because not all stablecoins are regulated, and so, as former bankers, I think that was one of the highest criteria that we wanted to satisfy kind of coming into the market, because we think that there was the kind of wash away to, it's just technology, and now there's this kind of wash back that actually no, it needs to kind of merge and meld into traditional finance. And so with that on the basis of that, as the Chief Technical Officer, it's okay, how does one use the best parts of the technology about the public-private key pairs and the signings and the smart contracts? How does one design that to merge seamlessly into our regulatory and legal obligations that we're going to have in Australia? And so, with not an extensive list, but the first one is obviously our anti-money laundering, counter-terrorist financing obligations and under Australian law. Like, how do you satisfy that in a decentralized way when you don't necessarily know who transactions are happening to on chain? And so that takes quite a lot of thought, but we think we've solved that. So that spent a lot of time doing that, and how you onboard customers. And so that was our first requirement. And the second requirement was obviously we're going to hopefully at some point very soon have an Australian financial services license from ASIC. And there's obligations under the Corporations Act about how do we need to have a prudent risk management process and governance process around that, about minting and burning and managing reserves and segregation of duties and all that kind of stuff, all of which is actually perfectly easy to do that on a blockchain. And so, so I spend my time doing that, and surprisingly not doing any coding, because AI does that all for you now.
Does that now. I guess as a testament to Australia is now seems to be, after having a little bit of a slow start, seems to be getting a bit proactive about digital currencies, and the Reserve Bank has started off Project Acacia, and this initiative is to explore potential applications of Australian dollar-backed stablecoins in various sectors. Now, you and Catena Digital are involved with Project Acacia. Can you have just some of the use cases that you see, and how they potentially benefit, or not potentially, how they will benefit everyday Australians?
Everyday Australians. So it's at the moment, I think Project Acacia is exclusively fixed to wholesale use cases, which means, everyday retail person in the street, it's not going to be quite touched yet, but I think it's touching wholesale as essentially a testing ground for what will eventually be retail use cases that should should strip significant amount of costs out of that are borne by everybody with a super fund, everybody with a bank account, everybody with like taking insurance. There's just kind of these multiple middlemen who are just taking a lick on every single transaction. And I think that the idea of Project Acacia is to really strip down and disintermediate middlemen in that process. And those middlemen are actually our former employer. And or one of the many. And so one of the great examples is, people managing their super funds. You always have a reasonable portion of cash within your super fund allocation. Depending on how old you are, somewhere between like 5 and 15%. And the reason is that cash gives you an optionality on the future, right? If there's a significant market correction, you should reduce your cash position, put it in risky assets, and have it as like a car stabilizer on your portfolio. And so you're always having this kind of cash position. And unfortunately, cash is like the lowest yield because it's the lowest risk asset, it's the lowest yielding asset. And so any costs that are borne on managing cash is actually quite impactful on it because it's such low rates are like just at 4% at the moment. And so one of the first use cases we'll look at is deposits. Like how does one allocate into deposits in say your super fund account or something? And maybe everyday Australians don't understand this, but this is it's such an embarrassingly manual and paper-based almost process at most banks.
Yeah, Brad Jones, the assistant governor of the RBA, has brought that up on a number of his speeches, how inefficient the current banking system is. And I guess that's why the RBA is coming in and doing Project Acacia.
Project Acacia. And so, so if you tokenize money in the form of stablecoins, which can then be the settlement unit for any transaction where you want to place a deposit with a bank. And you also tokenize the deposit, say like a 1 month deposit, 3 months deposit, 6 months deposit, whatever it is. You can essentially just be there with your money, have a platform that feeds prices from all of the banks, and then you just decide. You say, okay, that's the best yield. I'm happy with the risk of that bank, and that's the best yield. Click, go, and that seamless process of like what we used to now on our iPhone is just go, and it kind of works. And so that's the I think the vision of Project Acacia. Whereas at the moment, the current thing is it is literally these manual processes of people keying in and taking money out of bank accounts. And so not only is that, as you say, inefficient, and when you say inefficient, read expensive, but B, it's prone to error, like significant error. And so those two things, and the banks have to hold capital for errors. It's called operational risk capital, and obviously the costs impact on what yields can be paid to customers and stuff. So it's good for people making deposits.
Yeah, it's quite interesting because from a technology point of view, you usually get trickle down from what I would say the equivalent of wholesale goes down into retail. And if you look at the auto industry, the great technical innovations come in Formula One cars, and 5 years later they're in the passenger vehicle,
ABS brakes or something.
ABS brakes, stuff like that. But this technology and the whole crypto industry seems to be coming from a retail level and then pushing back up into wholesale. Like you were saying just then, clicking stuff on your iPhone, you think that'll be that simple, that kind of technology would already be happening at the banks when they move money around. But as we know, foreign exchange is still settled 2 days after you do the transaction.
2 days is a long time in finance, to paraphrase somebody else's words.
Yeah. So stablecoins. Now let's have a look at this. We touched on a beginning that there's about $200 billion of stablecoins that are in circulation at the moment. It's about $60 billion a day of turnover currently. But that turnover, if you look at M2 in the US, 21 trillion. So if you think 21 trillion, 200 billion, it's a very, very small percentage, sub 1% of US dollar turnover. $60 billion a day of turnover. The foreign exchange market turns over $7.5 trillion a day. So again, much less than 1% of the turnover of the foreign exchange market. And stablecoins currently are about 99 point something percent US dollars. So where do you think stablecoins go? Does it trend towards that $7.5 trillion in the foreign exchange market? Is foreign exchange being T+2 settlement ripe for a bit of disintermediation? What do you think the next 3 years track for stablecoins?
Yeah, I think I break it into kind of probably 3 phases. I think the first phase, like over the next 12 months, is certainly for our stablecoin, is that we will enter the market where there's already existing US dollar stablecoins. And for Australian citizens who are holding those US dollar stablecoins, obviously they've got currency risk because they're holding something that's US dollars, and arguably they're reporting currency, certainly to the tax office, which is the biggest pain of your reporting, is in Australian dollars. And so any capital gains that you get on your currencies, you have to kind of like report that as capital gains, to the ATO at the end of the year. And it's not necessarily it's a massive amount, although the Aussie has depreciated quite significantly over the 12 months. You probably know exactly how much it is. Was it 15% or something?
Yeah. The way I look at it, over my career, in the low 60s, you're better off holding Aussie dollars rather than holding US dollars. Yeah. It might dip a little bit lower, but you sell in the 80s and the 90s and you buy in the 60s. So that has held good stead over the last few decades. So
I think it's a good following wind for us, right? Because we're like putting an Aussie dollar stablecoin into the market at the time when it's actually reaching the point where holding a US dollar stablecoin gives you the FX risk, and there's a kind of limited upside benefit from it from this point on because it's had such a huge run. And so we're entering a market where there's already stablecoin buyers. And so we just need to convince people that actually you don't want to hold the currency risk because you can have an Aussie dollar one rather than a US dollar one. And the second thing is, if you, as a customer protection issue, you've got these US dollar stablecoins. I have no idea what jurisdiction they're managed in. I can guess. Like, I think Circle's probably in the US, right? But the other ones are like Hong Kong, maybe El Salvador. Like, I don't know if you've ever worked through a legal case in any of those countries. I imagine you've got, firstly, your reduction of currency risk. Secondly, our Aussie dollar stablecoin is the jurisdiction's Australia. And so, and in addition to that, if we do anything poor, ASIC is going to come in and whack us. And so
they know where we live.
They know where we live. So you got much more protection from a currency perspective and a jurisdictional perspective with the Aussie dollar stablecoin. So my prediction for the first year is we're going to enter the market and we're just going to, it's the existing stablecoin investors who are on digital currency exchanges are going to have it. And I think that'll kind of scale pretty quickly in the first year. But then I think what will happen is as soon as you start having pairs trading, say US dollar stablecoins and our Aussie dollar stablecoins, people will realize they can do spot FX transactions on chain without the 2-day settlement that you're doing for traditional. And so obviously one of the biggest pairs is US dollar, Aussie dollar. And so I think the second phase is people will just do like almost like a decentralized treasury management. If companies want to have, operations in the US and Australia and possibly even Europe, they can have a decentralized treasury where it's just kind of wallets that, they rotate between people have shared keys between different jurisdictions. So I think that'll be decentralized treasury will be the second one. And then the final one, once we've proved Project Acacia, that delivery versus payment on chain for deposits and bonds and bills and a whole host of others in real estate. I think then the year 3, it'll be people actually doing financial transactions on chain, like buying a deposit, buying a bond. And then we've won, right? We've essentially put everything on chain.
Look, I think the financial transactions on chain compared to, and you look at how they currently work, I could over my career, some great examples of where the current system doesn't work. I was in Europe and we had a a dollar Swiss transaction with Crossair, which was a Swiss airline that no longer
exists. Yeah.
And we sent all the Swiss francs in the morning in London over to Switzerland, and we were expecting US dollars later that evening coming back when the American banks opened. Crossair at midday declared bankruptcy, so the administrator stopped any payments leaving. So we'd sent our, I think it was 30 million Swiss francs to Switzerland, and the US dollars did not come back that night. So stablecoins and blockchain will remove that risk. And at another place I worked, we sent a 200 billion yen to Japan, expecting 2 billion US dollars to come back overnight. And it was a Friday night, and the 2 billion US did not come back. And it was a very long weekend.
But it was. They missed the cutoff.
They'd missed the cutoff. So stablecoins also, as well as making it efficient, just remove that risk completely.
Could you imagine when the protocol developers for like Bitcoin or Ethereum were just having a meeting and somebody says, "Hey, I tell you what, let's take a snapshot of the time on the internet every block, and then when it's 4:30, let's just turn the blockchain off until 7 o'clock the next morning."
Yeah.
Could you imagine what they like? And clearly you're not going to do that. And this is one of the power of blockchain, is that it's 24 hours a day, 365 days a year.
And the smart contracts,
they do it.
They do it all for you. So on the technical side, so Catena, what chains do you plan on looking at? Have you got, so if you can give us some information around what you're looking at there, and any differentiators. What do you think Catena's stablecoin, what's its differentiator? What does it have to offer?
So well, maybe at this point is give a good shout out to Fireblocks, because our back end wallet and key management system is Fireblocks, and we've always had a great relationship with them, and they've been awesome with us on this journey. And so because of that, it actually gives us an opportunity to do tons of different chains that integrate them in naturally. And so obviously, firstly, we're just going to do an ERC20 token on Ethereum as our go-to-market strategy. And that's because of the demand that we're getting off some of the digital currency exchanges. That's what they want on the chain. But very quickly after that, we need a couple of other things. We need a high transaction volume, low gas fee blockchain. And there's a few options for that. We're thinking Solana's probably going to be the choice there, but we're not totally committed to it yet. And so that would be more of a micropayments remittance, non kind of institutional use case payments. And then you talk about the kind of differentiation as well. Obviously, as a fully regulated stablecoin issuer, we're actually also looking into the Red Belly network, which is a Australian-grown blockchain.
CSIRO, University
CSIRO. I think even the Australian government is a shareholder, if I'm not mistaken.
And you've got to plug that. That's my alma mater.
There you go. CSIRO is your alma mater. And so we're and actually to be I think a node validator on the Red Belly network, you actually have to do KYB, and so they need to know who's submitting transactions. So I think we're going to onboard with Red Belly and then mint Aussie dollar stablecoins on the Red Belly network as well. And so it's kind of a fully compliant, regulated blockchain. And so if you're talking about Project Acacia, doing regulated transactions like buying bonds, selling bonds, telling the truth about how much volume you're trading on your bonds, for example, you need a fully compliant and regulated blockchain. And so I think one of our unique differentiators is we'll be going onto that chain and providing a stable coin for a bunch of financial service use cases where you need to know who everyone is.
So if you're the Australian government, the AOFM, for example, in your view, it would make sense that they issue Australian government bonds on Red Belly network.
They should be issuing now. I would hazard a guess. I think they did do a study about how much the economy was going to save on the digitization and blockchain tokenization. Was it 14 billion per annum? 16.
So Brad Jones quoted a $13 billion savings for corporate issuers because there are, if the bonds were tokenized and liquid, because there's like a liquidity premium that's required by super funds, traditional investors, because the Australian corporate bond market is so illiquid versus the US or Europe. So I think 13 billion saving for Aussie corporate issuers if we tokenise the corporate bond market here.
Well, that's significant. Yeah, because obviously we've worked on trading floors before and we know this, which is, if a bank goes in and says, hey, we'll do your debt issue for a corporate in Australia, and they book build, say they do 400 million Aussie or something, they book build and then they kind of, spray it out to all the clients on the book build at whatever price it is. Usually they like, primary buyers like a little bit of a high yield, because they're essentially kind of buying it. But then these corporate issuers have issued to all these investors. And then at some point the investors may say, I've held it long enough, I want to sell it. When those corporate, the asset managers who are holding that, they can really only sell it back to the bank that did the issuance with the corporate, because because they did the primary deal. They probably got credit lines for one of the trading books to allow secondary trading, and so it's only probably maybe the book builder and maybe number two has brought credit lines for buying that bond back. None of the other banks will have it. And so actually you're only really selling to kind of two banks. And so therefore that will impact prices and secondary market. And so actually it has a whole follow-on effect of what the yield that corporate would be paying. Whereas if it's on the blockchain, any other investor who's passed the KYC can make a bid for that paper. Therefore it should, if you're increasing the supply of buyers, it should theoretically reduce the yields of the bonds, right? And so that's definitely, I can see where the 13 billion comes from.
There's an opportunity for Stu and the team at
Imperium
Markets.
Yeah, we should plug Stu as well at Imperium.
Yeah, our friends over at Imperium Markets, that would be an opportunity for them. So that brings me on to traditional banks. As you and I both know, they haven't really embraced stablecoins. Otherwise, we still may be at our previous employer. When do you think the traditional banks and the traditional finance sector, super funds, etc., come into the space? And the only data point we've had is the AMP, and I think the amount was that the AMP bought $27 million worth of Bitcoin in one of their funds, but there hasn't been much other activity in the traditional finance sector in Australia. You got a prediction for when they will come in?
Yeah, that's a great question. I think you have to, even though as we said earlier on, like it's like, the first time you saw a color television versus a black and white television, when you see it, you kind of can't go back. But even though the pull is incredibly strong of why an organization would transfer some of their core business functions on chain and using smart contracts, because the reduction in operational costs, the reduction in operational errors and efficiency, it's all, there's a fantastic pull from blockchain from that. The push is the impetus internally to the banks. And it has to be like advocates within the banks who are pushing into that direction, because there's a lot of career risk associated with making the wrong choices. And Australia is no different from any other jurisdiction in the world. It is replete with financial services businesses making mistakes on technology projects. And so there's a lot of, should we say, the people that would push internally, they push, and perhaps they're like us. They go, you know what, actually, this is just too hard to do it internally. And they will self-select and leave and do their own startups. And we're too. And I know there's other people who have left banking as well. And so actually it kind of reduces the number of people pushing internally. So I don't think there's the impetus at the moment internally to banks. So what you've got to do is it's got to get it's got to get to the point where it's so painful, it's politically unpalatable for a chief technology officer to not push it, because it's like, if I don't do this now, then I'm going to be left really offside. I'm going to look stupid. And in the same way that, nobody ever got fired for choosing IBM, I think they will do the nobody ever got fired for choosing Ethereum. And so I think they'll use Ethereum use cases first, but it's probably not going to happen until it becomes a real pain point. It feels like 2026 is when they're suddenly like, okay, now we have to really act. I think we've talked to bankers now, and now they're like, it's on the agenda now, but it's not at a pain point. It'll be a pain point next year.
Yeah, I guess what's interesting is here in Australia is that the crypto and digital currencies, digital assets seems to be a bit of a bipartisan from both sides of politics. Both sides of politics are making noises about supporting it. So we've got the election coming up. So in reality, we should start seeing noise about actual regulation. The Labor Party have a digital assets roadmap. The Libs are definitely coming out. They're on the front page of the AFR supporting the industry. And we've got the Reserve Bank and the DFCRC supporting with Project Acacia supporting the industry. With that environment, where do you see Catena in 3 to 5 years?
I think we're in an awesome position, because I think it's literally clear blue water that we're sailing through, because there's nobody else out there going in the direction that we're going in, like fully regulated, compliant Aussie dollar stablecoin, serving existing stablecoins and then pivoting into traditional finance solutions. And so it's going to be awesome for us for like a year. We're just going to be able to scale as quickly as we can possibly do. I think next year there'll be some entrants, and it'll possibly like either one of the banks who has got a stable coin already, they'll probably put a little bit more coal into the furnace on that one, because they'll realize that, they should do. And then of the other 3 banks, they'll have to do something. But they'll be in a real difficult pickle, right? Because of the big 4, none of them will trust each other for a stable coin. So they'll all want to have their own. So they'll all be fighting out like 4 dogs fighting over a bone. The great thing about 4 dogs fighting over a bone is that it's the 5th dog that usually gets it. And I think that's us.
Oh, there you go. I certainly hope so. Rob, it's been an absolute pleasure having you on the show today, and thank you very much for your time.
Thanks for the invitation.